Hello, everyone, and welcome to today's Law Path presentation. My name is Ryan Tan, and today we're going to be going through navigating taxation for startups, the essential tips and strategies. And we are joined by one of our in-house accounting experts, Lee from Pop Business. So we work closely with Pop Business to provide our legal advice and accounting plan, and we've also launched a new annual tax compliance plan for bookkeeping services in the last few months. So Lee will be joining us shortly, and he'll be going through these tips and strategies. Just a bit about LawPath. We've been in business for over 8 years now. We've served over 400,000 small businesses just like yours through our contract management system to help manage compliance and connect with lawyers and accountants in a single platform. And over the last 8 years, we've garnered over 10,000 five-star reviews. We've saved $100 million in legal fees, and we're just getting started on this process to help small business with their legals and accounting. So I will pass it over to Lee. He's a senior account manager at Pop Business. He's a chartered accountant, so highly qualified to give very detailed advice and great advice. And he has some specialties, as you can see here, around accounting, tax planning, structuring. He works with SMEs and also financial reporting. So without further ado, I'll pass it over to Lee to kick off the presentation.
Thank you, Ryan. Hello, everyone. My name is Lee. I'm a senior accountant from Port, and a bit of background about myself. So I've spent over 10 years in the world of tax and business advisory, helping small and medium-sized businesses in Australia to navigate the often challenging tax landscape in Australia. And over the years, I have gained a deep understanding of how challenges it is for business owners, and as well as the opportunities that lies within effective tax planning and strategies. I have also had the opportunity to work with a diverse range of clients, which has allowed me to gain a broader understanding on how to leverage tax regulation to benefit startups and fuel their growth. So I love tax, and I'm keen to share my knowledge with business owners and entrepreneurs like you today. So for today's webinar, my goal is to demystify tax, make it very simple, very clear, easy to understand, and give you some actionable strategies so you can go and apply in your own business. Again, thank you all for joining me today, and let's dive into the world of tax and explore some tips and strategies together. All right, so in terms of topics to cover, so today's agenda is aimed to arm you with some essential knowledge and practical strategies to navigate this tax world. Firstly, we'll look into the foundational tax consideration that pretty much every new business must be aware of. So basically understanding your obligation and understanding the tax landscape in Australia. Next, we'll look into choosing, what sort of tax incentives and concessions that you could utilize to benefit your business and yourself. And then finally, we'll focus on other considerations such as, what are the different types of tax lodgement that you have to do, what are the due date, when you should be doing it. And again, throughout this webinar, I would encourage you to, engage, ask questions, and share your, thought and experience if, you feel like to. Thanks again, and let's get started. All right, first one is effective tax strategy for Australian startups. Now, there are three key considerations that I would like you to be aware of. So number one is your business structure. And number two is the pros and cons of different type of business entity, also known as the different structure. And then what are the tax incentives and concessions that's available to each of them. Yeah. Now, talking about business structure, why do we make it the number one point that we have to talk about today? So business structure in a nutshell is pretty much a foundation of what you are going to do with your business. The reason is having a solid structure set up will make your life a lot easier in the long term and potentially save you time, money, and headache. So in Australia, there are four main type of different structure that you can see in there. So trader, partnership, company, and a trust. Or you can do a hybrid where you have a combination of, different companies grouped together, owned by a trust, for example. And each of these structure would have different tax implications that I will go through in the next slides. All right, starting off with sole trader. So sole trader is essentially the simplest form of a business structure. The benefit of that is it's very cost effective. It's very cheap to set up and maintain. And it is usually a good starting point for someone who wants to test a new venture, starting a new business and not sure whether they would, want to stick with that or just wanted to see how the market would react. So it is a good cost-effective way to do it. However, there's a couple of limitations that we need to be aware of. Number one is you don't necessarily have much room to minimize your tax because whatever you make will end up in your own personal name. So if your income is high, you are getting taxed at a higher marginal tax rate. And also, commercially, it doesn't provide you any asset protection. Yeah. Next one. So we'll move on to partnership. So partnership is essentially a group or collection of individuals working together. Similar to a sole trader, you have low starting up costs, also low maintenance costs. In terms of the disadvantages, also you don't really get much asset protection in here. Tax is essentially at your own personal level as well. So basically, when a partnership makes profit, the profit is divided equally to the partners, and the tax is essentially assessed on the partner's level. So I can give you an example, right? So you have partner A and partner B having a business together. The partnership makes $100,000 in net profit. It means partner A gets 50, partner B gets 50K, right? However, tax is treated differently. But let's say partner A, who's got employment income, investment income, his taxable income outside of the partnership is already, say, $200,000. This extra 50K goes to his personal name, would be taxed at 49%. That is the 47% top marginal tax rate plus 2% Medicare levy. Partner B, on the other hand, if he doesn't have any other income, this 50K will solely be his taxable income, which is taxed at a much lower tax rate because you get the first, $18,000 tax-free and then 19% at the next bracket. So I hope that makes sense in terms of tax for you. The next structure that we are looking at is a trust. So trust, you have different types of trust. You have family trust, unit trust, or family trust can also be discretionary trust. But for the purpose of this webinar, we'll just make it very simple in one type of trust. So trust is a very good vehicle for minimizing tax and asset protection. The reason is when income is streamed through a trust, you have the option to distribute it to the lower income tax bracket individuals or a bucket company. So essentially, you can lower your tax from 49% to, say, 25%, for example. It is also good for asset protection because it is also a separate legal entity where you can park your valuable asset in there. And if anything happens to yourself personally, these assets are protected. The other benefit of that is when you have a trust, you can stream that money to a separate wallet. So generally, when I talk to my clients, I try to divide their world into three separate worlds. You have a business world where you have your business running, making money. You have a personal world where you deal with your personal matters, your home, personal income, and you have a investment world. The trust sits in the middle here where you can stream income from your business world to that separate world that build wealth outside of this world. So essentially, they are somewhat connected but protected from each other. If that makes sense. Now, this advantage of having a trust is if you don't make money, then you cannot really distribute the loss to lower your taxable income. That is probably the number one thing that you need to be aware of. However, when the trust makes a profit, it has to be distributed. So let's say when sometimes you don't have anyone to distribute money to, you still can't retain the profit within the trust because you would get taxed at top marginal rate as well at 47%. So that is something that you need to be aware of. However, it can be resolved if you have a good structure set up. And again, in terms of cost, trust is very complex, so the associated cost would be higher. All right, the next one we're looking at is a company. So commercially, company is essentially one of the best, if not most popular option that people would use. The benefits of that is it's very scalable, especially if you're looking at building something for future investment, capital raising. There's a lot of good ground for asset protection because it is also a separate legal entity, also very effective for tax. And another big advantage is companies are generally qualified for a lot of government funding, any grants that become available. For example, back in COVID day, companies are or were available to a lot of grants that the government, from state to federal government, been injecting money to these businesses. In terms of cons, so in terms of tax, then company don't get CGT discount compared to other structure. However, if the whole group is structured well, you can minimize this sort of disadvantage as well. And again, in terms of cost, company is generally cost a little bit more to set up and maintain. All right, the hybrid. So what's hybrid? So hybrid is essentially a mix of structure that people can mix together to what do you call it, to fit their purpose and goals. So let me give you an example. So for people who has a trading business that they're looking to grow in the future, they usually have a dual company setup. So you have a trading company that's held by a parent company, which is called a holding company. This setup would help with future expansion. For example, you have a trading company here and you have a new line of product, you can set up another trading company under the same umbrella of the holding company. And in the future, if you have IP and anything that's related to the group, but you don't want to have it in the same company, you can just keep adding on to it. And then the holding company depends on how you want to manage it. Oftentimes, people have a family trust that holds a share in the holding company. So the benefit of this structure is that it gives you both the asset protection and also the flexibility to grow in the future. So that is an example that you might want to look at if this scenario suits you. Obviously, talk to your accountant to see what structure would fit you best. Depends on your current stage of trading and lifestyle as well. All right, let's move on to some tax incentives and concession. So number one is ESIC. So this one is very good for business owners or entrepreneurs who are looking at capital raising. So ESIC is essentially a government incentive that helps businesses attract investor. So basically, the benefits here are more to the investor in terms of tax. So you can see there are two types of key incentives in here. Number one is the investor would get a 20% tax offset on the amount they invested in your company. And number two is they have a modified capital gain tax exemption. So talking about tax exemption, like usually when you buy shares or when you invest into a business and you sell the share for again, you have to pay tax on it. With ESIC, for the first 10 years of owning the shares, you are essentially exempted on the gain that you make on the shares if this business grows. So that is very attractive to a lot of angel investor. Therefore, if your business is qualified for this grant, I highly recommend looking into that to attract more investment. Next one is research and development incentive. So R&D. So R&D is essentially a Australian government incentive to encourage business to spend more money on research and development on what do you call advancing innovation. All right. So the R&D tax incentive program provides eligible businesses with tax offset for the cost involved in this research and development plan. So the application can be quite tricky. So therefore, you would need to speak to a R&D specialist on whether you are qualified for this grant or not. And then once you are qualified, you will have to register yourself with us industry, get the specialist to prepare what's called a R&D schedule, and then you liaise with your accountant to integrate that schedule into your company tax return. Thanks. Next one is ESOP. So ESOP is Employee Share Option Plan. This is designed to attract and retain talents. So oftentimes we have businesses that are growing, and it's, in this competitive, market, talented people are usually very valuable and get headhunted by other companies. So ESOP is a good way to help retaining people. Right. So generally what you would do is you set aside 8 to 10% of your equity to give it to your executive or key personnel. Usually when you give shares to people, the person who receives shares would get taxed on the value of the share that they are given to. However, for startups, if you are qualified for the ESS startup concession, the person who received the share can have their tax delay to a future time when they dispose and make money on these shares. So that is quite attractive to people to get the investment in the existing company and future growth. Next one, we're looking at a couple of key ongoing tax concession for small businesses in Australia. The number one thing is that there is a difference in tax rate between small business and larger business in Australia. If you are a small business, you get taxed at 25% versus 30% for the larger business. You also get access to a simplified depreciation rules. So essentially, it makes your administrative burdens a lot easier. So a couple of things you can see in here. You can pull all the assets that you buy, for the business into what's called a pool, and then you can claim a flat rate deduction of 15% for the first year and 30% for ongoing years. Other than that, you also get access to instant asset write-off. So for certain asset you buy, you don't have to depreciate it over the year. You can claim the deduction immediately in that financial year that you buy. So usually that adds a lot of value. It saves a lot of money on tax, and that cash flow can be used to reinvest in the business. Next thing would be the immediate deduction for startup expenses. So things like, professional advisors and government fee that you pay to set up a company or a trust, or if you go talk to a lawyer or, an accountant like me to advise on what structure that would best fit your goals. These are fully deductible. And in the next slide, we'll look into some example in more details, and maybe you can take note of that if you want to. All right. So here I have listed a couple of expenses that would allow you to claim a deduction immediately. So again, for professional and legal accounting advisors, you can see that it's the structural advice, costs associated with raising capitals, and the government fee, ASIC fee, stamp duty, all these are immediately available to you to claim as a deduction. Now, next we're moving on to understanding the tax considerations for new businesses. Okay, here we'll look at two key considerations. Number one is, taxes. What sort of taxes do you need to know, and what are the lodgement due dates for them? And then I'll touch on the importance of early tax planning. Now, there are a couple of basic tax requirements for a business that you need to know. Number one is income tax. So income tax is an annual tax that you have to lodge. So, for example, if you run a company, you would have to lodge an annual company tax return. And the due date could vary, depends on the size and your lodgement history as well. Usually, if everything is lodged on time, no issue, then the due date is usually in May the following year. So for example, your 2023 financial year tax return would be due in May, usually 15th of May 2024. However, if you were late, then the date get brought forward, or if it depends on the size or different arrangement that you may have, the date might be different. So it's best to check with your accountant on the exact date that you need to do and plan ahead. So you can always, lodge your tax on time. Personally, when I deal with my clients, I prefer to get the tax done early. It doesn't mean that you have to lodge early, but it's important that you know how much tax it is for this, year, and you can plan ahead. So for example, for 2023, I tend to do it, before October or even before Christmas. So I know, all right, so let's say we have 50K of tax payable, and we have 5 months from, January to May to prepare for cash flow and planning, things like that. I think it's very valuable to know what sort of tax you need to pay. Or if you get a refund and you do it early, lodge early, get the refund, get some cash injection, it helps grow your business. The next one is GST. So if you run a new business and your estimated income is $75,000 or more, you might be subjected to GST. So it's obviously depends on the industry that you're in, but a general rule of thumb is that if your income is over 75K, you need to register for GST and start lodging that either quarterly, monthly, or annually. So GST, what you would have is you collect GST from the sales that you made to your customers, and then you can claim a credit from the expenses that you have made to your supplier. So every quarter you will have to lodge what's called a business activity statement, which is a BAS. You pay the net amount of GST if you collected more, or you get a refund if you pay more. So if you are a startup, you spend a lot of money to invest into the business and you haven't made much sales yet, you might be able to get a GST refund. Next one is, sorry, can we go back to the slide? Yeah, is PAYG withholding. So PAYG withholding is relating to the tax taken out of the salary paid to your staff. So I think most of you would be very familiar with that. PAYG withholding is also reported in the BAS as well. So these days, because of STP, single touch payroll, the ATO knows this info already. You just have to finalize it in the BAS to confirm that STP agrees to, the info provided in the BAS. And payment is at the same time as when you lodge the BAS. Last one is PAYG installment. This is an area where I see a lot of confusion from business owner. People often think PAYG installment is the same as PAYG withholding, but it is not. So PAYG installment is a company tax that is considered a prepaid tax. So for example, if you do your 2023 tax return, you have the tax payable, the ATO would use that info and predict your future income tax for the future year. So let's say 2023 financial year, you have a $10,000 tax payable. The ATO would roughly think, all right, so in 2024, you would pay about $10,000 as well, adjusted for inflation and everything. So it would make you pay a quarter of that every time you launch a BAS. So every quarter you see a PAYG installment of $2,500 added to your BAS. So that is something that you should be aware of and plan for cash flow as well. Yeah. Fine. So in here, I've got a couple of due dates that I believe that you should be aware of. So here we're looking at the due date. There's two types of dates. Number one is the original due date. So if you lodge your own BAS, the original due date are the date that you have to lodge and pay your BAS by. If you have a BAS agent or a tax agent who will help you with lodgement, then you get an extra 4 weeks to lodge and pay. And then lastly, a couple of common tax consideration for expanding business. So let's say you're been in business for a while, you're growing, will be new taxes that you need to be aware of. So one of them is fringe benefit tax. So fringe benefits tax is, the tax that is applied on the benefits that you provide to your employee and even yourself as well. So an example is that if you have a car and you let your employee drive it for work and personal use as well, then usually a portion of that would be taxed, and that is reported in what's called a fringe benefit tax. And then next one is payroll tax. Payroll tax applies when your workforce expand and grow. So there is a threshold for different states within Australia. When you hit a certain threshold, you would have to start paying some added tax on top. So, well, look, it's quite a funny tax because you hire people more, giving benefits to the country, but you somehow get taxed for it. It's quite debatable. Some people like it, some people don't like it, but you need to be aware of it. And then reporting frequency to the ATO. Fringe benefit tax is annual as well. The fringe benefit tax year is slightly different to your annual financial year. So FBT year is from March to April, and payroll tax is lodged differently. Payroll tax is a state tax, so you have to lodge it based on their own time. Next one would be CGT on disposal of business asset. So when when your business grow and you buy more asset and you sell the existing asset, there could potentially be some capital gain on that, something that you need to be aware of so you don't get caught out on unexpected tax. And then one of the interesting one is capital gain tax on restructure. So when you start a business, right, you may want to start with something very simple, something cost effective, but over time, when the business grow, you have to restructure to a more suitable structure at that time. That will create a tax problem because you are either changing shares from one entity to another, or you're selling assets from existing business to a different business for obviously a better asset protection or a better tax effective for the whole group. That would be subjected to CGT, and you would need specialist tax advice on it. Other than that, a couple of key common issues that I see on a daily basis is director's loan and family trust distribution. So be aware that when the business makes money, it is the business money. It's not your money. So if you take the money out of the business, you have to know how to take it out in a tax effective way. If you just take it out as a loan and not pay back, you are going to get caught in what's called a Division 7A loan issue, and that could be expensive in terms of tax. I think that's all. That covers everything. I hope everyone got some value out of that. I'll probably give it back to Ryan to carry on.
Thank you for that, Lee. I just wanted to go through a bit about LawPath. In the polling, we can see that a lot of people are aware that LawPath does provide tax and accounting services. So as you can see on the screen, we've got our tax compliance add-on. What this is, it allows you to get the bookkeeping done with Pop Business through LawPath. So we do have an accounting plan that provides unlimited calls with our chartered accountants like Lee. Now, the bookkeeping add-on, as you can see here, it allows you to get all of your annual tax filings, your quarterly GST filed, as well as an end-of-year tax consult and the preparation of financial statements. So this is an add-on that we can provide it to customers who are looking to get all of their compliance sorted for the full year. So here's the exact breakdown. You've got the annual or quarterly BAS lodgements that are required. There's one coming up in 6 days on the 28th. So we'll prepare this for you. We'll lodge it for you as well. The annual business tax return, this will include the preparation and lodgement. Now, to use this plan, you also are required to be on our legal and accounting advice plan, and that is very beneficial. It allows you to use the consultations throughout the year in preparation leading up to end of financial year to get all of your tax minimization, tax deductions sorted, classification of your income, payroll processing, paying yourself as a director, so you can get all of these matters sorted. You don't want to approach this 1 week before the due date, but we'll lodge that return for you as well to the ATO. We do provide annual financial statements, so we'll prepare the business balance sheet, income statement, and cash flow. This is important to help you forecast liabilities that may fall due, such as the payment of superannuation, payment of your GST, payment to suppliers. So we'll give you a holistic picture of where your business sits in terms of cash flow. And then an annual year-end consultation as well. So the accountants at Pop Business will sit down with you and try and understand your accounts, where you're sitting in terms of the forecasting, the liabilities, and how you can best prepare for next year. You can utilize all of these services in conjunction with our accelerator program that is running on the accounting advice plan. If you want to look at things around your business structure, paying yourself as a director, looking at your group structuring, protecting assets. We can do all of this in conjunction with the end of year tax consultation. So this service is, we're trying to bring everything into one where you can get the advice done, you can get the bookkeeping done. We also have an asset compliance plan if you have any company changes, so we can get all of this sorted for you. So your compliance and your tax is done as well. So in terms of the process and the steps, you sign up today. Our team will reach out within 24 hours to conduct a general assessment. So you'll be sent a calendar link from Pop Business directly. You can schedule on a time, and they'll just understand your company's current tax status. Do you owe any lodgements? Have you got to prepare a nil return, or what your next deadlines are? Step 2 will prepare you for the upcoming lodgements. So if you have missed anything, they will inform you of what needs to be done and the fees for that service. Obviously, this is a past lodgement. For future lodgements, we don't charge a fee. And then number 3, relax and let us handle your tax compliance seamlessly. So again, we're aiming to make this process very smooth and simple for you. LawPath can be a one-stop shop for your legal, your accounting, and your compliance each year. So the exclusive webinar offer that we have today is we're offering 10% off our legal and accounting advice plus our tax compliance plan. So if you've been thinking about getting a bit more accounting advice, understanding things around, say, payroll processing, GST, forecasting, liabilities and expenses, paying yourself as a director, Division 7A loan agreements, and Division 7A loan repayments as well. These are all topics that we can cover on the accounting advice plan. Now, we've also formed a brand new partnership with Xero. So I can see from the polling that over 45% of people here are using Xero as their main accounting software. So again, that's fantastic. We provide support for the software. For people who are not using it, we've got a 30-day trial and 50% off for 3 months. So that comes complimentary with the package of accounting advice and tax compliance. So if you'd like to take up the service, or you have any particular questions, or you want to understand what credits you might have in your account from a legal advice plan or an essentials plan, please key yes into the chat below. One of our sales team will reach out this afternoon. We'll let you know where you stand in terms of your accounts, any discounts available, and we'll give you a demo of the platform and explain this a bit more. We understand it's not always easy to understand things like this. So if you have any particular questions around the package or the inclusions, our team would love to jump on the phone this afternoon and walk you through it all. So here's our link as well. If you do want to take up the Xero partnership directly, you can do so and get the 30 days and the 50% off for 3 months. So what I might do is I might just pass it back to Lee. We have a few questions that have come through. Can you see those questions, Lee?
Yeah, I can see it. There's a few questions here, and can start addressing it now. So we have a question from Dana here asking, is simplify depreciation rules the same concept as negative gearing for property? Well, the short answer is no, they are quite different. So what is negative gearing for property? So negative gearing for property is essentially your cost is higher than your income, and you make a loss in property investment. This loss is then used to reduce your taxable income, give you some tax back. Simplified depreciation rule is what's applied to a small business only, and it's only focused on what you can claim as a deduction for an asset in terms of tax only. So let's say, if you buy an asset of $10,000, right? If you're not a small business entity, then you might have to claim a deduction throughout, say, 5 or 10 years, instead of claiming the full reduction of $10,000 for this year. Maybe to make it a bit clearer, so if you are not a small business entity, you can only claim $2,000, for example, per year. So your taxable income is only reduced by $2,000 versus $10,000 if you are a small business entity. So the lower the taxable income, the less tax you pay. All right, I hope that answers your question. Next we have question from Elise. All right, so the question is, hello, could you please define what you mean by a immediate deduction for your business expenses? Is that simply an offset to expense against income, and that is tax determined on any profit? Okay, so similar to my previous answer, immediate deduction is essentially that you can claim deduction for the full amount for the cost of the asset in one go rather than spreading out through multiple years. So again, immediate deduction means you can lower your taxable income faster. All right, next one. We have a question about, can the director or owner take money from the business as a salary even without an employment agreement between themselves personally and their company? So employment agreement is more of a legal concept that I'll probably, advise you to talk to your lawyer in detail. Usually, if on a tax side of thing, right? If you want to take money out of your business, a couple of different ways that you can do. Number one, you can do a salary. Number two, you can do a director's fee. And number three, you can pay it out as a dividend if you also hold the shares in the business. What you should do in this case is that before end of the financial year, you should have a tax planning session with your accountant to see where your business is at in terms of profitability, where you're at in terms of personal income and expenses. And that's when the accountant comes in and give you some guidance on where and how much you should distribute money between different entities within your group to minimize the overall group tax. Or, if even better, you can get some tax refund too, depends on how you manage all these distribution. All right, I have another question here. To claim personal super contribution deduction in personal tax return, the amount is limited in the whole life. Let's say each year. Okay, so yeah, there's this question here that yeah, it's quite long, and let me maybe try to summarize what this person means in here. So sorry, I can't really say your name, but Shao Liu something. Yeah, so the question is, to claim personal super contribution, and I think the person is asking whether there is a cap that you can contribute throughout your life. Well, essentially, if we talk about, deduction for personal super contribution each year, you have a cap, not just like throughout your whole life, but you're looking at the yearly cap. So yearly cap at the moment is about $27,000, right? So besides, um, what your employer has already paid you, you have the balance of that amount that you can contribute to your super fund. And that amount would help you lower your income tax. Does that make sense? And that's it. There's no more questions.
We got one more that came in from Vinod.
Okay, there's one more coming in. All right. So if Vinod is asking, working from home, can I claim a tax deduction for mortgage payment? And how do I pay myself super? Okay, working from home, right? Can you claim a tax deduction for mortgage repayment? So mortgage repayment, I generally advise people to not claim mortgage repayment. The reason is it might affect your main resident exemption. So obviously, if you have a house that's got value in it, you want to utilize the main resident exemption. So when you sell it in the future, you don't have to pay any capital gain tax. If you claim, living expenses in your home, a portion of the gain will be subjected to tax. And usually the tax benefit that you have from claiming these deduction is not much compared to the benefit when you sell your property and get a tax-free capital gain. That'll be a lot better. Next question is, well, if we don't have any income coming in but want to pay ourselves, can we use the R&D? Well, firstly, you have to be able to substantiate that you are able to pay yourself. Otherwise, you wouldn't be able to claim an R&D. So yeah, I think first question would be generate income first before you can pay yourself and claim these offset. Next question. Can expenses incurred in setting up businesses be carried forward to future years if pre-revenue? What happened to those expenses if they are incurred in personal name? Okay, so expenses in setting up this can be carried forward to future in the form of tax loss if you don't make any profit for the year. So if you make a loss throughout the year, that loss can be carried forward in the future and offset your gain. What happens if these are in your personal name? Well, look, you can consider it as like a loan or payment on behalf of the business, and that's totally fine because when you try to set up a business, the new company is not there yet, so you got to pay out of your pocket. So that's very common. You pay out of your pocket, and then later on you charge it to your company. That's totally fine. Next question. If New South Wales is offering grant, do you advise it or against it? I'm not quite sure what you mean with this question. So if people offering you a grant and it gives you benefit, I would suggest that take it. Yeah. Next question is, can employees claim tax deduction for bonuses and salaries they receive? Well, it goes to a very fundamental tax concept. So if you are earning income and if there's any expenses or any deduction that relates to that income, you can claim it in your tax. Next question, how do you pay super yourself? So you can contact your super fund and ask them about the voluntary super contribution. It is important to maybe talk to them or to your financial advisor to see how much you can contribute in. Because if you contribute more than the cap, it could be what do you call it? It could be ineffective in terms of tax because they only give you a certain cap each year. You shouldn't be going over that because if you pay more, you get taxed more. Next questions. If you are a small business and employ someone with an ABN, which will mean that you're contracting to the person, do you have to pay payroll tax on his invoice? Yes. Payroll tax are subjected to a wide range of payment. So if you have contractors, the payment to the contractors will be considered as part of the calculation for payroll tax. Next question, are we able to claim part of our home rental as business expenses if we have a home office set up? So again, work from home deduction is a very tricky topic at the moment because the ATO don't really want you to claim much in terms of work from home deduction. So over the year, they reduce what you can claim. So in general, the easiest option is to claim the set rate method that they create. Otherwise, you would have to have a very detailed diary and also calculation of the area size of your property, what you can and that area has to be separate to your normal living life. It's very complicated and there's a lot of tedious work involved in trying to claim more than the set rate method for that purposes. All right, next question. If the company is set up in January 24, is a tax return due in May 25? Well, no. So if the company is set up in January 24, the financial year is 2024 financial year. That means your due date will be in the following year, will be 2026. Next question. As director, do we need to have an employment contract with our company so we can charge a salary and super? Well, yeah, that's more of a legal question, but generally, yes, if you are an employee, you should have an employment contract. I think I have covered everything. No more questions coming in.
Yeah, perfect. Thank you so much, Lee. Really great presentation. Just wanted to, again, go through the offer today. We've got 10% off the legal and accounting advice with tax compliance plan and the bonus zero subscription, which is a free 30-day trial and 50% for 3 months as well. So again, phenomenal offer that we've got here, considering in terms of bookkeeping, people often do this on an ad hoc basis. I can see from the polling before, over 40% of people don't have a regular accountant or bookkeeper doing the work for them. Often it does work out to be more expensive. So again, by putting it through a subscription plan with LawPath, you are saving, and you also have the year-round accounting advice support from our chartered accountants. So these are not just regular accountants, they are chartered accountants, as you've seen from Lee and his background before. He's obviously, a lot of years experience in the industry, and we help out with sophisticated group structuring and more complex tax affairs as well. So if you are interested in getting some advice from a legal standpoint, from an accounting standpoint, the lawyers and the accountants, they do speak to each other. So they are across your business as well. You want to get the tax compliance done. It's a one-stop shop. You don't have to worry about any kind of tax affairs or compliance. LawPath will do everything for you as your ASIC and your ATO agent. So if anyone is interested, please key yes into the chat below. Even if you are just curious and you want a bit of a demo of the platform or to understand some of the inclusions, we'd be more than happy to walk you through the platform and go through everything as well. Again, if you do want the standalone zero offer, we do have it on the page here. So this can be viewed on our website. You can take the exclusive offer through LawPath as well. So again, thank you to everyone for attending the presentation today. I have just launched a feedback poll 1 or 2 minutes ago. We'd love to garner your feedback on today's presentation and see what you got out of it and what you'd like to see in future webinars as well. But I'll leave this presentation open for the next few minutes if anyone has any last questions or comments as well. But thank you for your attendance, and thank you, Lee, for your presentation as well.
Thank you, Ryan. Thank you, everyone.